Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Jacob Garza. Jacob is the co-founder of REEP Equity, a vertically integrated multifamily investment firm that focuses on acquiring value-add assets in the San Antonio, Texas region. His company controls over 1,800 units, valued at over 130 million. Jacob and his wife, Arlene, live in San Antonio, as does his business partner, Chris Martinez. Jacob, welcome to the show.
Hello, Juan. It's good to be here.
Awesome. No, it's a pleasure to have you here on the show. And, I know that you have a ton of experience and, you're going to be able to add a lot of value to not only myself, but my audience and anybody, who's able to get a hold of the podcast and, and YouTube video as well. So, I guess we could go ahead and get this thing started with, tell us a little bit about your background. Tell us, first of all, where you're calling us from, and then, kind of go into your background a little bit, and then we'll kind of, dive into, real estate and multifamily a little bit.
Sure. I'm calling from San Antonio. That's where we're based out of. And we lived here. We're all here, all three of us here full time. I guess my business career started at the age of 26. I started a software company. That was my first one of three. I sold my last one in 2007, and it was a property management software program, and it was based out of Dallas. Okay. And we had just over 100 employees when I sold it, and I sold it in 2007. I was a sole shareholder, and from there we decided to move to San Antonio, and that's where we've been since then.
Awesome. So what made you decide to get into real estate? What was the trigger point there?
Yes, all along I've been entrepreneurial. And even when I had my software company, certainly in the later years, the 2003s, 4s, 5s, and 6s, I accumulated some opportunities to invest in real estate. And I was actually about to do that in the Dallas area in apartments on a passive level. And then I was approached and took about a year to sell my company, and that was very intensive to sell a company. So I decided not to do that and focus solely on getting the company ready for the exit. And so when that happened, our kids were third grade and I guess the sixth grade, and we have some family here in San Antonio, so we decided at decision point whether we were going to stay there and do apartments or we were going to move here. So that's when we decided to move in 2008. And as you recall, Juan, it wasn't a really good year for lending and the economy.
Yeah. No, 2008 was, I think most of us, can relate that, it was a pretty bad timing for people that were trying to get into maybe real estate, at that time, because, lending was pretty bad. Nobody really wanted to talk about real estate, at that time. It wasn't until like 2010, 2011 when things were towards the bottom and where, there's opportunity, right? So, but a lot of people did, they were on the wrong side of that, So what was the deciding factor on wanting to sell the company again? I mean, you had it for a good while, and, seemed like, you're pretty successful in it. So to exit on a company that's, pretty successful, that's a big decision. So, especially if you're going to transition into something else that's you're not related.
Oh yeah, and you're right. I had we had 22,000 customers across the United States in 9 countries, and we managed about 3.3 million units underneath our management software. And simply, I was approached. There was an equity firm out of Ohio that was coming in and doing a roll-up in our industry. And their value proposition really wasn't to sell more software to property management companies. Their value proposition was to sell insurance and all kinds of cable and all kinds of services to the users that were managed with this software. So they paid a multiple of 16.7 on a revenue basis. I know.
So that's pretty awesome, to say the least. So that was, I guess that made it an easier decision for you to exit and to focus on something else, right?
It absolutely did. And I thought I was going to get into real estate at that point, and they bought it. And so, yeah, it just delayed it a few years, but ultimately I got into it.
So then you know, like you said, you thought about real estate, and when was the time that you actually, created your company and And even before that, tell us about your first property, because I know that you had a smaller property as your first property. Wasn't it like a 24 unit? Um, yeah, tell us a
Mm-hmm.
little bit about that as well.
Sure. So in 2012, we purchased a 24 unit property here in San Antonio, and we're pretty hands on. And it really didn't have to go fast at that point. I wanted to go and kind of learn the actual business. So this may sound a little odd, but I did all the maintenance on it, and Arlene did the leasing on the 24 units. So we spent about probably 6 months doing that. It wasn't a real big property. We paid $500,000 for it back then, sold it for 1.2 million about 27 months later. But it gave us a chance to take some classes, if you would, at the apartment association. I'm a type 1 HVAC guy, certified pool operator. And when we get in the conversations a little bit more about what we look for in properties, that really helps put the lens on, if you would, when we go evaluate properties. And that really helped me throughout. And it was a lot of fun, but it's certainly something I obviously wasn't going to do at the property level forever. And then we purchased more properties after that.
Got it. And I think that's a way that a lot of us start. I did it myself. When I had my 32 unit, I was out there. When tennis called, I was one of the guys. I went out there. When the other guys couldn't go out there, then on a Sunday, I was like, okay, well, I told my little boys, I'm gonna have to be out there and make things happen. It is what it is, but you get to learn a ton, right? And it's a good learning experience, but it's not something that really is sustainable if you want to grow. It's something that it's a good learning experience, but eventually you have to take the next step, right? So, and that is a step that you did. So I guess we can progress into that. And your company is called REEP Equity, right? So tell us a little bit about the background and the name of that. Where the name came from, and when you started that.
Sure. It was started in 2015, and REEP, R-E-E-P, stands for Real Estate Equity Partners. And the partners, I'm very fortunate to have two awesome people with me on this journey. Chris Martinez, he's fantastic. And then Arlene Garza, she's wonderful. So we all come together, and we have different disciplines that we both, all three of us, bring to the business to really focus. I think do a much better job of peeling back the onion and looking at these opportunities. And we're getting better, of course, every day at doing this. And that's REEP, and that's when we started in 2015.
And you just said that you have two awesome partners, and that's what it takes in this business. You have to work with people that can basically complement your weaknesses or your strengths, and that's what it looks like. You have a strong team. So what kind of portfolios? What kind of property makes up your portfolio? What kind of properties are you going after? Are you looking at Class C, Class B? Any kind of value add? What does your typical property look like?
Sure. We focus on multifamily. We don't do anything else from that. That's our expertise, and that's where we want to create lots of value and gain levels of unconscious confidence, if you would. So the properties that we like, Juan, I don't know, you've probably come from the same study. From a macro level, right? The environment has to be good for apartments, right? You have to have a landlord friendly. You got to have jobs coming through, salary increases, hopefully, not a one-sided economy like a harbor ship or something, an industry that's just one-sided. So we like a blend, cost of living low. We like employers to go, wow, this is a really good place. So, San Antonio kind of fits that mold in the fact that we're not a Houston, okay? We're just not. So I think some of the companies with a bunch of huge intellectual property probably wouldn't come here. But a lot of companies that are on a second tier level do move here. And we have a great infrastructure. A lot of call centers are coming here. Some manufacturing is coming here. So, Toyota moved, and they're building a bunch of plants about 10 years ago when they moved here. So we really fit a place in Texas that I think contributes, if you would, to the overall wealth of the state. And that's just worked out extremely well. And they're kind of analyzed. What we focus on is, of course, the workforce housing, right? The B and C. Mm-hmm. So from a micro level, we like properties that are easily seen and have traffic. So that by an elementary school or middle school, we like that. Busy roads, We like that. And so those are kind of some of the areas that we look for. The things we don't like, I don't know if you want to get into that.
Yeah, sure.
We don't like chillers, and we don't like properties that have galvanized piping. For various reasons, but those we just won't stay away from. We'll just stay away from, I should say.
Got it. Yeah, because you have a chiller system. For those of you guys that don't know about that, then it's basically one HVAC. It's one AC unit basically is what cools the whole property, right? So if that thing goes down, then the whole property is going down, and that's not a good thing. That's not a good thing for your tenants. Instead of having one person down, you're having the whole property go down. And that was just one example that you mentioned. The chiller systems.
Absolutely, and their function is, of course, water. It loops water all the way through underground and through the ceilings and through the condensers, so it's hot or it's cold. And these loops, they're called loops. They're very old, right? Chillers were in the 60s. So if you didn't take care of the water, it's hard water. You end up having pipes and leaks, and it's just very expensive. So we just decided to stay away from that.
Got it. That makes sense. Okay, so what kind of improvements are you looking to do on your properties? What do you look for? What does it have to have? As far as value add, like that, you can, it's appealing to you.
Sure. There's a 3-part question to this. When we go look at properties, when a REEP goes on a property, I put on 3 different lenses. Okay, I put on my life and safety issues. The lawyer, if you will, the personal injury lawyer. I look at a property for, is a pool up to date? Are the trip hazards completed? Are there any exposed wires? If it's HVAC units that are on the floor, which on the ground, most of them are there covers on there? So that's the first lens that I look through. The second lens I look to is, if I'm a resident, what value do I see? So, are there playgrounds? Is the pool open, and is it the nice color? Is it sparkling? Is it inviting? Are there any amenities on the property? Is there a gym or a workout facility? Do they have wipes? Do they have music playing? Does the TV work? Does it smell? So, of course, there's opportunities if they don't have that, but is there a playground? So are the fences working? So that's, and that's just on the outside. The interior is a lot we can talk about, but that's what I look for when we go look at a property, or the lack thereof. And there's of course opportunity. And the other one is more from the investor, from the CapEx. And that is, are the roofs in good condition? Is the siding and the fascia and the soffits, are they in good condition? Is a parking lot? The boilers, if it's 3 boilers on the property, or just 2, and they're very expensive, they have to heat up really quick. And so if they're not, doesn't mean it's a bad property. It just means we need to pencil that in for the long term of the hold on the property. So, if we could check those boxes or just get an assessment on where all that is, then we go back and go, okay, do we have a play here? Got it.
Yeah. And what kind of improvements are the ones that you see that add the most to the NOI, the bottom line? What kind of improvements is that? Interior? Is it more amenities? I mean, what are you seeing there?
So you said it right, and I like the fact that you've been on property and you've worked them, because I think people forget who the ultimate end user here is. It's the resident,
right?
It truly is. So you hit it right. And the interiors. What's the experience like when they walk in? And it can be anything from sloppy shoe molding or sloppy caulking in the bathroom to adding USB ports and adding some of the amenities that we add on the inside. Then on the exterior, you hit it right. It's about playgrounds. It's about the pool. It's about outdoor grills. It's about a pergola. It's about dog parks. It's about fitness centers. It's about business centers. Some of these people, when they first move in, need a computer to go to. It's a coffee center. It's a lounge area. And we're already experimenting with workspaces that they can come and rent and work during the day. They don't work out of their apartment. So those are, I think, that's kind of the new value add that we're moving to in workforce housing, that we're going to see differentiate us from everyone else that's out there, and continue to work in a space that's cap rates are compressing, but there's still value to be made you just have to be completely engaged with your resident and identify the properties that marry those, so you can be evenly yoked, right? You need to go in with value. You need to go in with what you're going to do as far as the amenities you're going to put in there. So.
Yeah, no, that's a great answer. It's a big viewpoint in what to look for and what not to look for. You know, that you said earlier as well. And you mentioned cap rates compressing. So let me ask you this: you know, are you still looking, even though the cap rates have compressed a lot, are you still looking these days to find more properties, or what is your strategy there? Because I know it's pretty heated. You know, you can say whatever you want to say about the market, and we're at the top of the market. We're the 8th or 9th inning. Nobody really knows. I mean, I think, you know, really the best strategy there is to find a property and find you know, the fundamentals are there, and you know, you get a good long-term debt, and you know, it could make sense. But what are you doing? What are you doing these days?
Sure. When you look at the space that the 80s and the 90s properties, I think we can both agree they're not building those anymore. Okay.
Yeah.
And then when you look at the economics of who is available to live in these, you've got the baby boomer generation that really don't want the big house anymore. And maybe for lifestyles or economic reasons, they want to move into an apartments. And we have actually seen that in the last few years increasing. And that's only going to, in my opinion, only going to increase. You have millennials that are unfortunately 100 and you can pick a number, 142 trillion they owe. And that's just causing people to live in homes for economic reasons. Also millennials, some of them, they don't want to be tied down. They want to be able to rent and not have to worry about maintenance and pick up and leave when they want to. So I think when you look at those two levels, and the fact that home ownership is down in its lowest point in 40 years, that still creates the demand that's out there. And so, you know, we're still bullish on properties that are out there. We think there's a real demand. So yes, we are buying. You do have to be better at buying these days. And I think you have to be better at sharpening your data. There's a lot of data that's out there, but you got to go verify it. We look at reports all the time from these guys, and they're not real accurate. Some of them are. So I think more than ever, you have to be much more granular on your rents, what's really out there, what's wrong with the property, what's the story. You have to vet all of that, and you have to know your market much better. And then what I think the component these days is going to be the operational part. To me, that's the one that's going to carry you for near double-digit returns and doubling your money, and making sure the property is at a level where it's actually producing cash, which is what we buy. We buy for cash, right? We're not in this business and in appreciation, everything else. So, you know, when you kind of look at that at a high level, you know, a micro and a macro level, and marry the operations part with that, to me, that's a good business model. That's a good plan, and you should be setting yourself up for some pretty good success.
Yes, and you mentioned operational, and you know, you have to have you know, good operations, and that is something that you guys do well. So tell me a little bit about your management, you know, company, your management arm, and I know that you have also a construction arm, right? So you know, tell us how that integrates into your whole you know, business plan, and you know, how that helps you as well when evaluating the property. And also, you know, I would imagine that it also helps you on the cost side, the capex. You know, you're able to get things done at a lower price point. So tell us a little bit about that and how that actually benefits you.
Sure. When we created REEP in 2015, we were actually third party at that point, and I think there's still a place for third party, and there's a lot of individuals that do very well managing third party, and they make good returns. When we got together, we actually felt like, number one, we actually wanted to create a management company, and we thought we could add value and expertise and advice based on our business experiences and whatever else we bring to the table to create a company that's as good as or better than what's out there. So we made a decision, I guess, a year and a half ago. We opened up an office. We invested some money. We hired some accounting, hired an HR. We brought in somebody out of Houston to manage our portfolio. She's experienced at 7,000 units. We're 1,800, so we've got some scaling up to do, and that's exactly the plan. We wanted to bring in someone who was experienced in that. So, all the puzzles fit together. So we said, okay, let's bring in a management company, and that has that's done well for us. I mean, we've been able to come in and have, I guess, better. I don't want to use the word control. Better growth strategy that aligns with us. For example, one of the things I think that's an advantage of having your own management company is when we close on a property, and you know what it takes to close on a property. It takes like 70 days by the time you tour it and close.
Mm-hmm.
Well, 70 days ago, when we toured with the broker, our regional is there, our DM is there, our construction guy is there, and we're there. So we're able to, from day one, look at the property. And once we look at all the property, we go back that afternoon or that evening or whenever it is, and we're able to put together a plan for a CapEx budget and the market. So when we close, they've already done the due diligence on the property. They've already seen the property 3 or 4 times. So day one, and that's real critical that's what I was saying, operationally, you just have to take off and just plant that CapEx money, get it invested, make a turnaround on the property, get the residents. And so that's a whole different discipline in itself. So having them work on that for 60 days or 70 days and let it bake, and we're all changing things out and moving it in. By the time that day rolls around, we're not only ready, we're really ready.
Yes. Yeah, I love that, because you're able to get a big head start on, versus somebody that's, kind of doing his own tour and by himself and just kind of, looking at things. I mean, you're able to take, several key players with you on that first day. So you're kind of doing a due diligence, that first day, just on the tour, and so you're able to get a better idea of what kind of, business plan to implement on that specific property and what works best. So, I like that. It can take you to the right level, and really at the end of the day, it's for the best interest of your investors, right? And you're getting them the best returns that you possibly can. So, which leads me into my next question. How do you typically structure your deals? I know it can vary, depending on the property. It can vary depending on what kind of value is needed to be done on that property and what kind of CapEx, whatever. But, tell me, how do you structure your deals, typically with your investors, and so they get to know?
Sure. Now, when you say is this the lending? Is that what you're talking about as far as the contract and deal points going forward, as far as trying to get under contract?
Yeah, no. I was referring to more like your passive, your limited partners. How do you typically structure your deals? Yeah.
For limited partnership. Yeah, we do 80-20 split. Mm-hmm. On the equity, and we do 80-20 split on the profits. So it's real simple.
See, I like that. So for those of you guys listening, and you can get so many different strategies on how to split the, your equity, your ownership on the properties. But if you're doing an 80-20 split like he does, it's so simple. You're doing 80-20, and on the back end is 80-20. It's just so simple. There's no waterfalls. There's no thinking about it. It's just pretty simple. I like that strategy, and that's that's a really healthy return for your investors, 80% for them. So I really like that. So let me ask you this as well. What has been your biggest factor to your success here up to this point, Jacob?
I would say the biggest factor is listening to people who have done it before. There's a lot of advice out there, and I still see it. I saw something this morning. Somebody was putting together on something, and they don't own anything. There's nothing wrong with that, but there's everything wrong with listening to somebody like that. So my advice to people that's out there is surround yourself with people who have, if you're looking for some advice, who have done it before, and early on, find someone who can coach you. If you're changing a receptacle in your home, You can Google that. You can find out where the common wire is going, where the hot wire, where the ground. Okay.
Mm-hmm.
You're trying to take out a carpet stain. You can Google that too. You want to buy an apartment complex, find a coach, find a mentor. And I did this early on in my software company and all the companies that I had before that. I got with a mentoring group or a peer group, and we sat around the table once a month, and we had stuff, but it was minimums that you had to get to join the group. You had to be X $5 million or up, and so we all kind of share these particular problems or challenges, or not even problems, where we're going to grow. All of us were very successful. So my advice to anybody out there is, well, no matter what you want to do, decide you want to do it, commit you want to do it, and then find the right people. There's plenty of people out there that will give you advice and guidance. And if you pay them, they'll give you coaching or mentoring. So that just, you've got the y-axis and the x-axis, right? You got your risk factor here, right? You got risk is really high when you first start anything, but you got your education here. The more education you have, the lower the risk, right? So just know that it's going to be a long road and a quite bumpy one if you go it alone, especially in this multifamily business. And if you've got more time, and if you've got more money, you can go through the process much quicker. You still have to go through the steps, but that's my advice to people.
I love it, man. And you hit it right on the nail. I mean, you hit the nail right on the head on that. That's exactly what you got to do. You can't do things, on your own, especially in this business. I mean, because it's just, there's so many different, ways that you can make a mistake if you try to go at it alone. And I love the fact that you said that don't take advice for somebody that hasn't done it. Surround yourself with people that have done it, that are successful in the business, and kind of model what they do, right? So I really like that.
Mm-hmm.
Jacob, it's time for our nuggets of wealth, and these are questions that I ask every guest every week, and hopefully they are able to help our audience here with your answers. So question number one, what key tip or advice would you give to newer multifamily syndicators or sponsors that are looking to grow their business?
Sure. Whether you're syndicating or whether you want to invest passively in deals, find a mentor or a coach. That's my advice.
Same thing. Okay.
Yep.
Got it.
Yep.
Great. What is a good tool, source, or platform that you use almost every day that can also help others?
Oh, that would, for business, is that business tool?
Yeah. For anything that you think that can be beneficial to others that you use it like on a frequent basis. Yeah.
Sure. It's simple. Put everything on the cloud, on the server. Put everything on the server so everybody has access to it. You can build your teams that way. And that'll help your growth strategy. You have to share information, and there's lots that's out there, from simple stuff to things that offer document locking capability or record locking capability right down to the very cell. So it's extremely important that you put that out there and you share it and build your teams.
There you go. I like it. And what book are you currently reading today? I mean, what was the book that you're reading every single day, or here the last few days, and that you're into right now?
Yeah. The last book I wrote, I've not written a book. I plan on writing a book. Let's see, was by Benjamin Hardy. And I'm going to forget the title because I just read it. Basically, Benjamin says that creativity is really lacking in our society, and we're all consumed with so much activity in our mind that our mind is only creative when we rest. And it does come to mind, this disconnect, and how millennials are a little different than certainly I grew up. I didn't have any of that. There was no internet growing up. I had 6 channels and a TV. Cable was coming out when I was a teenager, and I had plenty of time to free and do all kinds of crazy stuff. But we're missing that today, and I even find myself really associating with that word, disconnecting. And if you're going to hire a group, or certainly in the creative group or even in the business group, you got to take some time off. You got to disconnect. You got to let your mind clear the dust, and that thing will start sparking off some really, really good ideas. So, but the book I'm reading now is called Scaling Up.
Scaling Up. Okay.
By Vern Harnish. It's a thick read. I'll say that. There's a lot going on in that book. But we're on an operational level. We've got over 100 employees in our management company, and we bring in just about $20 million a year. So that's a real operation. It does need real management, strategies, strategy, execution, and cash. That's basically what he talks about. That's just a completely different level when you start running operations like that. And we're going to continue to grow. So that's a great book.
Okay. You said it's called Scaling Up. Okay.
Scaling Up.
Got it. Yep. Got it. Those are great points that you added there. And now let me go back real quick on the disconnect part. I was listening to another podcast where the host said that he actually, what he does is he takes his cell phone and he puts it in his trunk of his car. He'll do that every few days, and just to disconnect it. And he's not even touching it. He's not looking at it. He's not looking at social media. He's just focusing on the little things. You're focusing on your business and whatnot. But it's so easily to get distracted and to there's so much noise out there. And I think that's very important. And so I really like that you were able to bring that point up. So yeah, it was good. Where do you see your business and company here in the next 5 years?
6,000 to 8,000 units. And obviously we'll be in a couple more markets besides San Antonio.
Okay, got it. And would that be here in Texas? Is that the other markets that you're looking at?
Two that come to mind, top of mind, is Orlando.
Okay.
In between the two theme parks. It's very, very good real estate and continue to grow. It's not going anywhere. Those companies aren't going. They're not going to disappear. And the other one would be the Phoenix area.
Got it.
There's an enormous amount of growth. I think everybody from California is probably moving over there. So that's a good growth.
Two really strong markets. That's for sure. Okay, so at the end of your life, how do you want to be remembered?
Oh boy.
You're like, oh man, I haven't thought about this one.
I don't want to talk about myself like that. That's theoretical. If people look and say, he really helped me on a professional level or a personal level. He gave me some good advice. He was always nice to me. He was open. That would be fine with me. Yeah.
Got it. No, those are great answers. I love it. Love it. So yeah, Jacob, where can Commit to Wealth Nation go to contact you and find out more about your company, REEP Equity? Yeah,
we have a website and we're on social media. So it's reepequity.com. And they can also like us on Facebook, and that's a great place if they like us. We post what we're doing on a daily basis on the equity side, as well as our operations, our management side. So they're going to get a real flavor of how we're integrated and how we're able to insight on how we run our operations. And they can also contact me by email if they'd like. I'd be happy to respond to them. It's my name. It's Jacob at jacobgarza.com.
Jacob at jacobgarza.com.
Yep.
Got it. Okay. Well then, guys, if you want to learn a little bit more about what he's doing in his company, then definitely reach out to him. REEPequity.com. Check out his Facebook page, and also Jacob at jacobgarza.com. So Jacob, I really appreciate your time, and you shared a lot of value and experience with us, and so I really appreciate it, and hopefully my audience was able to get some good pointers as well, and I wish you continued success.
Well, I wish the same for you. Thanks for having me on. I really appreciate it.
Yeah, thank you.